Welcome back, everyone. Our final speaker for this morning is Stephen Romick. Steve is a portfolio manager of the Global Flexible Fund, and he's from First Pacific Advisors. Steve, thank you so much for joining us this morning.
Thank you for having me and for joining the first quarter 2026 Nedgroup Global Flex Update.
Great. Thank you so much for sharing your time with us. Steve, I guess just to kick off then, how has the fund performed relative to its performance indicator?
Well, Global Flex has beaten its benchmark performance indicator, which is a mix of MSCI World, global bonds, and a small amount of cash in recent months, as well as across the 1, 3, and 5-year periods.
Thanks, Steve. I guess it's a relatively short time period, but if you can please highlight some of the investments that may have proven to be meaningful to the fund's returns over the past 12 months.
This slide that you see on the screen shows the fund's top 5 contributors and detractors. And you'll note that Global Flex's top 5 performers contributed 8.2% to its return, while its bottom 5 detracted 2% from it. Just to highlight a couple of the names, we know one from each side. Alphabet, it was the fund's greatest contributor last year, and it's been in the fund since we took over its management in 2013. We've sold shares along the way, yet thanks to the company's terrific execution, stock prices increased more than 4.5 times from the fund's average cost, and higher still when compared to our earliest purchases when the fund was smaller. In the 12 years we've held the stock, there have been periodic corrections driven by fears that its core search model was obsolete, including concerns due to the success of new AI-based search engines, a weak economy's negative impact on advertising revenues, regulatory antitrust concerns that could result in the forced divestiture of Chrome or Android, or that Google might no longer be allowed to pay billions to Apple to be its default search engine. Or that Google Cloud is always going to be a weak third behind Amazon, AWS, and Microsoft Azure, and how much Alphabet might have to spend in R&D and CapEx to ensure its relevance in the years ahead. Lots of fears. And many of them drove the stock to an intraday low last year of approximately $140 at the beginning of Q2, only to rebound to as high as approximately $329 in Q4 as more aggressive remedies sought by the Department of Justice here in the United States didn't come to pass. Meanwhile, Google's own Gemini AI gained traction, YouTube became the most watched platform in the world, and Waymo, the autonomous driving business of Google's, continued to increase its penetration, just to name a few of the positives. As it happens, we often receive phone calls when stocks we own are down. And Alphabet version 2025 was no exception. Amidst the stock's weakness, we hold firm to our sanguine view of Alphabet's future, and were rewarded for it last year. Given its higher valuations and the future's inherent uncertainty, we did take the opportunity to sell some shares into strength, marginally reducing our position. To focus on a couple, well, it's two companies on the detractor side, but they're on a factor-based. They're very similar. Charter and Comcast, the two largest U.S. cable companies, and two of the fund's top 5 detractors. Both have struggled in a very competitive market. While telcos continue to offer more high-speed fixed wireless access and fiber to the home, while cable broadband losses are inevitable, there will eventually be a bottom. And with intelligent use of free cash flow to pay down debt and opportunistically repurchase shares, these stocks are arguably quite cheap when viewed over a 3 to 5 year horizon. That said, the KPIs must be monitored to ensure that we don't bury our heads in the sand.
Thanks very much, Steve. That was very comprehensive. I guess as a follow-up then, how has the portfolio changed over the past year?
Well, we have marginally increased cash in Q1 as we await opportunities. That was in response to elevated valuations. We continued to trim positions in 24 and 25. However, with recent market volatility and geopolitical headlines, we've been able to rebalance the portfolio and add to names in which we have greater conviction. Global Flex has always held growth and value names, with the portfolio being a bit more growthy at times and more value-centric at others. And even when it's growthy, we're still value centric. We're not buying the high PE momentum companies. But today, the fund has definitely been tilting more toward value. And during the quarter, we added 9 new positions and increased 10, while exiting 4 positions and trimming 11, largely due to valuations.
And is there any particular region or sector that stands out from a portfolio positioning perspective at the moment?
Well, the fund's current asset allocation reflects low bond exposure at 1.8% due to poor valuations, which also helps explain, the aforementioned 40% cash exposure, which hasn't changed much in the last year. And the most prominent risk exposure remains the communication services sector at 9.8%.
Now, if we look at the geographic composition of the fund, how does it differ by revenue versus domicile?
Approximately 44% of Global Flex's equity exposure is to companies based outside of the United States. As we often point out, where a company is based is of secondary importance to the quality of a business and the price at which it trades. More relevantly, if we examine the revenue composition of our portfolio companies, we will see that they derive about 60% of their sales from outside the US.
And Steve, where are you finding better value in markets at the moment?
Oh, we're all aware of the recent volatility. Even at the top of the hour before we started recording this call, when you asked me how you navigating this market, valuations have certainly fallen from the beginning of the year. With some of the world's major regions sitting at or below their 20-year averages. Notably, the U.S. is still further from the average. We continue to avoid the speculative areas of the market where we deem the reward for taking risks insufficient relative to the potential return. As you'd expect, when it comes to deploying capital into new names, it is rare to find our recent purchases on the 52-week high list. Instead, you're more likely to find us shopping on the 52-week low list for looking at those companies that have fallen from favor, but might still be good businesses with reasonable growth prospects. This has led us over the last couple of years to healthcare stocks and numerous other one-off investments, both here in the US and abroad.
And would you say you're finding better value outside of the US?
There's always something to do in the markets, even when they're expensive. And right now we see more relative value outside of the United States, while we prefer to own high quality companies, regardless of their geographic centricity. We believe they should outperform, these high quality businesses should outperform the market over time. That does not mean their shares will perform well in all environments. While we own Merck, KGA, the global medical giant, and Sodexo, the second largest food service company in the world, a host of foreign small and mid-cap companies, and many other businesses, there's no guarantee that all will go according to these individual companies' management's plans, or for that matter, our plans. Nevertheless, if the future is remotely like the past, and we've been doing this for more than 3 decades, we should have some good winners from these recent seeds we've planted to chat about in the future.
Thanks very much, Steve. That was very punchy and comprehensive. We certainly appreciate you joining us.
And we appreciate your long-term partnership, and we've had, having the good fortune of like-minded investors who maintain a similar value-aware point of view and a long holding period. So, to the old and the new, listen to this call. We will seek to continually earn your trust through the inevitable market cycles for the capital that you've entrusted to us. Thank you.
Thank you. As you say, putting investors first. Thanks so much, Steve.
Thank you.